Hey, happy holidays.
Hi, David. It's good to meet you. Finally meet you. So, watched a lot of your episodes and such, and have learned a lot along the way. And so, yeah, absolutely, fantastic to meet you.
Awesome. So, why don't you tell me a little bit about who you are and your background and what you'd like to talk about today?
For sure. So, my name is Jim Jones, and myself and my family, we currently live in Lincoln, Nebraska.
Okay.
I've been a software engineer for over 24 years. I started coding when I was 12 and have just always loved it. Always enjoyed it. Even, with job, without job, whatever the case, I've just always have done that as a hobby and such. And so um, back in about 2011, a job took me to the San Francisco Bay Area, for which my wife and I moved out there. And then soon thereafter, about a year after, I started consulting with Bay Area startups. And so,
Okay.
yeah, I work with a framework called Ruby on Rails. It's kind of the language and framework. So I do a lot of like backend development on really large scale consumer sites. We're talking about like sites that maybe see hundreds of millions of requests in a day and such. So
Okay.
um, that's my background. And so along that period, I ended up meeting some of my best friends, Andre Camacho and Peter Krimmel, who they're not here today, but they're both also software engineers and have consulted with many Bay Area startups and such. And so, yeah, we have worked on side projects together in the past. Have tried to launch a couple companies. Have I myself have had some really high profile clients like Uber, PagerDuty. I currently am at Lime Scooter, the bright green scooters that you see in most major cities. And so we have probably about 70 plus years of collective software engineering experience. And
Okay.
so um, we have been discussing the idea of potentially acquiring a company, a large scale technology company, but we're also at the point of um, we don't know um, what like the threshold, what sort of acquisition target maybe we should be targeting. For me, my back of the envelope math seems to think about somewhere between 15 and 30 million if it were to potentially like support our salaries as well, along with obviously the other employees. Um, we're wondering if there's a way to structure the deal in some sort of manner
When
where
when you say that number, are you talking about revenue or transaction size?
revenue,
Okay.
revenue. And I know there's a lot more nuance and such to it, but obviously that's sort of the sizing of it, and from what I can tell, and I can share a spreadsheet that I've kind of been working through, and you can point out where I've gone wrong. So
Well, so can you describe ideally what this business would look like? And when it comes to the IT space and sort of this online, and like SaaS and all these other kinds of stuff. One of the big questions would be, you talking about let's talk about what the cash flow of the business would have to be, or is that important to you?
yeah, I think cash flow um, it is definitely important for sure. Just in terms of I guess cash flow. Yeah, cash flow is definitely important in the sense of when we would overtake this company, there's definitely a few initiatives that we would want to take on in terms of the idea being we want to triple revenues within a 3-year time span. And so most of the places where I see my clients falling down in terms of our like marketing initiatives of like establishing appropriate cadences with existing customers, pre-existing customers, and that sort of content generation, especially things that are very unique to both the prospective customer and that's unique surrounding the value proposition of the company. just generally that content takes time. And so I think we definitely need high cash flow in terms of like to service those sorts of initiatives.
Mhm.
Also, if it was like enterprise SaaS, scaling up the sales team in terms of so that we can both do outreach to prior customers and prospective customers as well. And so yeah, that's where I see that in terms of the cash flow.
Okay. So the size of business that you're talking about with revenues of like 15 to 30 million dollars sounds like just your team. You're talking about a salary expense to these new owners of like $1 million.
Potentially between the three of us, my guess would be about 225K per person on there.
Okay.
So yeah, so that puts about 700K
Okay.
range.
So you all right. So like you're to and these types of businesses are outside of my normal area of everyday expertise, but given the valuations that can exist in this kind of marketplace, you're talking about a business that even if it just had an EBITDA of $750,000, I mean, this online Silicon Valley space, I mean, it could be selling for 8, 10, 20 times that, right? So
Right.
we're talking about multi-million dollar deals. We're not talking about something that is going to have an SBA loan attached to it, probably.
Probably not.
Yeah.
I guess, and that's probably one of the things I want to discuss. And I can send you the link to my spreadsheet. There was a deal on my radar that was I approximated the numbers just because of like the NDA and such. But I was wondering if the numbers that it was reporting within its prospectus would have supported or what it would have taken to support like the team, the three of us as well. And so let me send you the URL to the spreadsheet here.
Are you going to put it in the chat?
Yeah, I'll put it in the chat.
Okay.
There you go. And so I'm looking at the hypothetical acquisition tab lower. So this is obviously much lower in terms of what the numbers and
So basically what it says here is asking price 4 million, gross revenue 2.1, gross profit 2, discretionary earnings 1.4, and with basically an implied multiple of 3 times discretionary earnings. So costs only $100,000, right? So I mean, this is why, for everyone listening, this is why businesses in this space sell for such incredibly high multiples and stuff, because they're very leverageable. Like you could double the revenue of this business and those costs probably wouldn't get much higher than what they are now.
Correct. Yeah, and that's sort of what's led me down to this path. Like obviously there are businesses in the SaaS space that are at much lower asking prices and such, but I often ask myself the scaling of the outreach efforts, that effort seems to be about the same, whether it's a 500K business or a $5 million business and such. And so I'm always left wondering on the question. It's like, why would you not take a higher acquisition target? And so, then obviously we get into the discussions of like personal guarantees and such. And
Yeah.
we all have families, and I don't think I could not ask my family to say, hey, let's put the house on the line, even though I am very confident in my ability to double to triple revenue. But I cannot do that. We have family, small children, and I don't want to put them in that space. And so that's what led me to kind of reaching out to you and wondering if there's like a different way that we could structure a potential deal where maybe it's more performance-based, maybe there's more upside to the investor, where we could take the personal guarantee off the table. And so that's where we're at right now.
Okay. So this business has sales of 4 million. It's very different from a business that you described a few moments ago with sales of 15 to 30 million. So tell me about this business. Like like you don't have to tell me what it is, obviously, but how do they make a sale? Is it something where people just go on a website and they say, yeah, I want this, and they put in a credit card number? Does the product sort of sell itself, or do they have to have salespeople that go talk to people or anything like that?
Correct. They are listed in a few different marketplaces,
Mm-hmm.
and that, along with a big SEO initiative, and that seems to be what drives a majority of their revenue. It's SaaS based with annual recurring revenue. So yeah, their customers just basically renew once a year, so they do get all of that revenue up front. And so that is their primary driver to
Okay.
these revenue.
And so tell me about how important or how integrated their solution is for their customers. Is it a personal solution or a business solution?
I think you have customers on both sides of
Okay.
that. There's definitely they have a couple different solutions, and one of the solutions is definitely serves a larger like corporate market that use it for some of their like internal portals and some of their public facing portals. They have a customer based solution which tends to have cater to processes that their individual customers would probably be more apt to be utilized and such. So it did appear, if I remember right, the split was probably like 70%, I would say, small independent consumers,
Mm-hmm.
or small independent companies, and then maybe like 30% corporate as well. And
Okay.
so yeah.
And so is it something that delivers continuous value all the time?
Yes, yes. And for those particular companies and individuals, it provides workflows that they would be utilizing every single day for to service their customers and such.
Okay. So there's going to be a switching cost because this is integrated in their daily work.
Yes, for sure. And there's probably within that they probably have a lot of assets tied up, like digital assets that are built around these workflows and that their customers utilize and access every single day. And so,
Okay.
yeah, they're definitely, the longer they would use the product, the more entrenched it would be.
Okay. So you're describing something that's super sticky. Like, so just the other day, I was having a problem with my computer, and I thought that maybe it was a driver problem, and I found some piece of software online that was $29 a year subscription, but it basically goes through, checks my computer, checks all my drivers, and then came up and said, "Oh, these 6 are out of date," and then click here, and I'll do it. And I don't have a problem paying $30 a year for that because it's like, how much of my time is this saving me? Like it's a great little tool, right? And
For sure.
so, but um, you know, that's different than me getting my employees to invest their time building our workflows around something that is, uh, like on Google Sheets, and then questioning whether I want to continue to subscribe to Google,
Yes, for sure.
right?
Yeah.
And so it sounds great. So my next question would be, why is it being offered at such a low multiple? Because typically these businesses are offered at higher multiples.
I would agree. And was that would probably have been like my next questions in terms of the due diligence. And I think there had been maybe another buyer backing out as well. And so which of course, the prospectus would be dismissive of that. Oh, they just lost funding or something like that. But there you never can quite know what the intent or what actually happened was until you kind of dig into that. And so I agree. I thought the multiple seemed very low for what the initial financials appeared to be, and especially with like the annual recurring revenue and such. And so, yeah, I think I didn't get that far because I'm still very much hung up on the like personal guarantee and such. And
Okay.
it was like it was I think SBA approved at the time, and so yeah, that's why I did not pursue it further.
Okay. Did you get any intelligence at all about what the other offer may have been?
No, I did not.
Okay.
I didn't.
So let me ask you this. You and your partners, how much money do you have together that you could put into this?
We could each probably put about 100K towards it. So say collectively, say 300,000.
Okay. And so not quite 10%. And this is a business of this size that, size wise could potentially be an SBA loan. I know it's entirely IP sort of cash flow based. There's a lot of SBA lenders that wouldn't want to do it just because there's no collateral. But it's within that framework. So when you made your submission for this call, you said you wanted to create a deal where you could attract an investor to come and be a participant with you, right?
Yes, and I think that's more from the financial side. I don't think we need anything in terms of technical direction. In fact, I think that would be one of the selling points, is that when we acquire the SaaS application, the company could literally lose all of its employees, and we will still be able to run this ship. Like we can mitigate the worst case scenario in that we are experts at running large scale systems, and so we could definitely keep the platform running, in that really worst case scenario and such. And so I think that would be
And
part of it.
you would be able to confirm that for sure during a due diligence once you had access to everything.
Absolutely. Like in fact, I would go through any sorts of technical screenings, anything that would be required of me to confirm that particular expertise for sure.
Okay. So there's a couple of different things. So obviously a lot of people would start off and say, like, you really only need a little bit of money if you're going to do an SBA deal, but then that of course would require the personal guarantee, and that's what you do not want to do. Correct. So if we're going to take SBA off the table, that means that we have to then consider what other sources of capital there might be. So there are individuals, there are banks, and there are the seller. There is the seller, right? That's kind of the buckets you have access to. And so any bank in any scenario is going to want you to guarantee, is going to want you to sign for any kind of money that you're going to get from them. That leaves investors and the seller. So the question is, what do you know about the seller's scenario or situation, or have they revealed anything about their motivation about why they want to do this deal?
No, and I think that's always sort of problematic on the prospectus, is that, it's usually either listed as retirement, or they've just become tired of the business and ready to try other investments, which I'm not saying everyone is disingenuous, right? Like there definitely are people with that reasoning and are ready to move on and such. But I think listening to your shows and other readings, it always requires, certain due diligence and really digging underneath to make sure that really is like the genuine reason and such. And so I think this particular buyer was ready to move on to other investments and such. And maybe, if I remember right, the ones he listed were much more passive. And so that's what he listed. And it's quite being on many software engineering teams, and there's a certain amount, there's obviously an expectation of uptime and such. Like I could see how, like, over years of running the same business, like, yeah, someone could definitely become tired and say I'm just ready to move on. So it's quite possible it was legitimate.
Okay. Um, the have you met the seller?
Uh, Not personally. I had listened to some, poked around, found some like interviews with that particular seller, and so kind of aware of his demeanor and his approach and personality, but never have met him.
Okay. So before you make any offer, it would be really critical that you have a meeting with the seller. And I would suggest that you have a meeting with the seller with your partners,
Mm,
so that you can all get a chance to sort of make sure that the seller knows who you are, because you would come across to me anyway as highly qualified buyers, the right kind of people who can, take this to the next level, certainly maintain it and make it run,
yeah.
right? And I think that that's going to be a key critical thing, because in any deal that you want to do, the cheapest source of capital for you is going to be the seller financing. And so having as much of the seller financing as you can is going to be important. So what I think we should do is we should just sketch out some hypothetical type of scenarios of what a transaction could look like. And then we can look at the pros and cons from both the seller's point of view and an investor's point of view. Okay. So
One question. So what do you typically see in terms of if the deal, if the SaaS app is being offered via a broker versus like, obviously this is something maybe I have directly arranged or did outreach and such. Do you see the intermediary broker basically, they want to get paid, their motivation would be to get paid. And so my assumption is that if I'm offering, I want some sort of large percentage seller-based financing, that the broker would detour the seller from that. What do you usually see?
it depends on a lot of things, because the assumption is that the broker wants the business to sell for the highest price.
Mm-hmm.
And I actually mentioned on another holiday chat call the other day, but that's not always the case. I actually say that more brokers are incentivized to sell the business as quickly as possible,
Mm-hmm.
because, if you can sell it for 10% more after a year of work, is it really worth that effort on the part of the broker? Right.
Gotcha. Yeah.
And so if this is for sale, and if offers have been made and deals have fallen apart, and then we have an offer that isn't reliant upon something like an SBA lender agreeing, this could actually be a really strong characteristic of your offer, right? To be able to say there's no SBA involvement here as far as a bank or anything like that. Um, One of the great things you can say to a seller, especially if you're just giving a down payment and asking them to finance the balance, is you can say, we can do this deal as fast as the lawyers can finish the paperwork,
Mm.
right? Because there's no bank, right?
Yeah.
So now the question of the broker's commission
Yeah.
is 100% between the seller and the broker. And so a lot of sellers might have the idea that if they sell a business and they finance 50% of it, that for some reason the broker only gets 50% of the commission. The commission listing agreement will probably say, nah, the total sale price is what the basis of the commission is, and that the commission is due on closing day. And then the broker will say, oh, like in this case, if it's $4 million asking price and a 10% commission, let's say that the broker is going to say on closing day, you owe me $400,000. So even if it's 50% seller financed and only $2 million crosses the table that day, the broker is going to want 400 grand.
Mm.
What the seller may say is, I don't know if I'm going to collect all the money. There's this possibility of this, that, or the other thing. And it really just depends on what attitude the broker takes. Sometimes brokers end up negotiating this stuff. Sometimes brokers will agree to take payments over time as the seller receives them. Very few want to do that, obviously. They'd like to just have it done with.
Yeah.
Um, I actually wrote a book called How to Borrow Money from Business Brokers, which was all about solving this kind of problem. And so the truth is, you don't know what's going to happen. it's also not really your business. It is 100% between those two parties. And it can become your business if one of them complains to you about the deal. So the seller could say, I don't know if I can do it in this way because my broker wants to be paid his full commission on closing. That can then open the door for you to make this an element in the negotiation.
Mm.
Okay.
Okay.
So for example, if the seller gets paid and the and then is collecting on a note, and the broker doesn't entirely get paid on closing day, let's say they're going to wait for some of the money, the seller could move away to another country, right?
Yeah.
The seller could leave the jurisdiction. You owe the seller money and you're going to pay them, but now the broker can't really exercise many legal options against that seller because they've gone to a different country.
Mm.
So it's often more palatable for a business broker to be owed money by you and the business versus the seller. So when I say it can be introduced as an element in the negotiation, what you might say is, well, instead of paying $4 million for the business with 50% seller financing, what we'll do is we'll pay $3.9 million for the business and we'll pay $100,000 to the broker in equal payments over 5 years.
Mm. Okay.
And we'll ask the seller to finance still $2 million, but we'll just pay the seller 1.9 on closing. In that case, you just actually increase the total leverage. But the broker might feel more comfortable with that because you are based in the US
Yeah.
and it's easier for him to sue you if you don't pay him, right?
Yeah.
And so that's what I mean by it can be introduced as an element in the negotiation. The broker's incentive should be to try to get a deal closed. And do you know how long this has been up for sale?
So the one I have in mind, it actually did sell. And so, but it had been listed, I want to say a good 5 to 6 months. And that's including, I think, the window of like where a deal had fallen through. And so, but I think collectively it was at least 5 or 6 months because
Okay.
I had it had kept crossing my radar. And so I was like, yeah. So I don't know if that's a bad signal or if it's just it was too large for most people to entertain or what the case is. But I would assume like there would have been a private equity group or something if the money seemed legitimate and such that would have entertained it much sooner. But I don't know. Like it's all hypotheticals. I don't know, honestly.
Okay. So let's think about some hypothetical deals for this. So the first scenario I'm going to sketch out is going to be 50-50. So you make them an offer, let's use the full asking price of 4 million. You ask the seller to finance 2 million, and let's make it look like an SBA loan. So 2 million over 10 years with 10% interest, let's say. So then the question is, where do you get the 2 million that you're going to bring on closing day, right?
Yeah.
As well as maybe legal costs and all the other transactional expenses that you're going to have. So you have 300,000 and you need another 1.7 million.
Right.
So now that there's no SBA involved in this, the percentage of ownership between you and your partners is not going to have to fall under any kind of guideline or regulation. All that we have to do is figure out what's going to be acceptable to the people that are going to provide the other 1.7 million. So the question is, who might they be? Do you know anyone with $1.7 million?
I have a few targets in mind. Yes.
Okay.
Like potentially.
Okay. So there's two ways that this $1.7 million could appear. It's either going to be a form of debt or a form of equity, one or the other, right? So either this is going to be shares or it's going to be debt. So it can also be a mixture of the two that we sometimes might be referred to as mezzanine financing because it's kind of in between the two. But I'll give you an example. You could, for example, say to an investor, we'd like to borrow $1.7 million from you, and we're not going to personally guarantee this loan. It's for this business, and we're going to pay 12% interest, let's say, right? And the person's going to say, oh my goodness, I can get half of that by investing in T-bills with no risk whatsoever. Why would this be attractive to me, right? And so usually private investors in small business deals, they are looking at an overall rate of return, including like the exit of the position at some point in the future. And I hear a whole bunch of numbers bandied about by people talking about this, like 30% IRR or 20% IRR, meaning any preferred return given on their investment plus their cash out from exiting the position gives them this overall rate of return. And the faster they get their money back and these extra returns, the easier it is to hit a higher number. And so an earlier exit's better than a longer exit. So in order to make this more palatable, we would either have to increase the interest rate, or we would have to give them some other kind of potential promise for how things might be better in the future, or for some extra money. So, because there's three of you and you have $300,000, this is the first thought that comes into my mind, is you could say, each of us is going to own 25% of the business, and Mr. Investor, as a gift for lending us $1.7 million, we're going to also give you 25% of the business, or we're going to sell you 25% of the shares for $1, let's say.
Yep.
Something like that. So now they have this $1.7 million loan for which you are paying 12% interest on, and they also own a quarter of the business. So if there's any distributions, they're going to get their fair share of that. And if you ever sell it one day, they would get a quarter of the money from the sale, because they're going to own a quarter of the shares. So that would be an example of how you could formulate this. And it's entirely up to that person, in the case of an individual investor, to decide if this makes sense to them or not. And so in my experience with people that actually raise money from investors, the hurdles to meet are, number one, the investor has to believe in you, just like the seller does. Like, to do a seller note, they got to believe in you. They got to think you're capable. They got to trust that you're going to do what you say. And then they have to, be confident in the business. And if an individual person is going to invest $1.7 million, you are going to have an individual who's going to be very interested in what's going on. They might want a board seat. They might want some degree of involvement or information at the very least to know what's going on in there. And if this person, if they are able to lend you 1.7, then they're going to be an accredited investor, right? They're going to have sufficient capital. But if their net worth is $2 million and they're going to lend you 1.7 million, they're going to be really keenly interested in everything that you do. A lot, right? Versus a person with a net worth of $20 million who is going to be able to afford a more relaxed kind of attitude, maybe.
Got it.
Right?
Yep.
So we need to think about who this person is going to be. The other pathway that you can go down is you can say, what if we had many people representing this 1.7 million? So you could say, we're going to create a series of debts, and they go by different names. They can be referred to as something called a debenture. So it's like a bond. Okay. So you can say, we're going to issue 17 $100,000 debentures. And these are going to feature an annual or quarterly interest payment. Let's use 12% again. Maybe it has to be 15. I don't know. We're going to issue quarterly interest payments on these debentures. But then for buying one of these, we're going to give you some stock in the company. And maybe each debenture gets 1% ownership of the company. Now we're only giving away 17% ownership.
I see.
You and your partners are hanging on to 83.
Got it. Okay.
Okay.
Yep.
But now what we've done is we've created a more palatable type of thing that can be more easily digested by a wider variety of potential investors.
Yep.
And so now we're starting to think, hey, wait a minute. In your working career, you've probably run across many people that were paid several $100,000 a year in the IT space.
For sure.
Right. And these people probably have savings that they could invest, and they're probably qualified as accredited. So you can avoid security rules that prevent you from getting a lay person to invest. And for one of those people, now it's just a matter of working your network to find enough of these people to make this investment.
I see. Hmm.
The other different dynamic here is one of influence or control. So you and your two partners owning 83% of this, having this array of smaller investors, you're in a more powerful position. You have obligations to them. You're going to have to report to them. You're going to have to show them what's going on in the business, et cetera. But the one investor who owns a quarter of the business who lent you 1.7 million, like they might stop by your office and want to look over your shoulder and maybe give you suggestions about the way things should be.
Yeah.
Right. Whereas these smaller investors are less likely to behave in this way. Right.
And does the seller-based financing portion, is that considered, that would be considered debt?
Yeah.
And so you don't have that issue with you should not have that issue with them, correct? Like, because it's just being paid as like a loan.
Yeah. But, and here's an interesting idea. I've seen this done before, where the buyer, let's say the seller says 50% seller financing. No, I can't do that. That's too much. Okay. What if instead he would agree to 25% seller financing, but part of that seller note is by him accepting some of these debentures too?
Hmm.
So now the seller has a seller note, but is also maybe one of these debenture investors and gets the advantage of that 1% ownership for each one.
See.
Or maybe they say, I'll do 25%, but I want the same deal as those investors.
Yeah.
Okay.
See.
So,
Yeah.
so in that case, you're talking about issuing far more of them. But I guess the whole point of the example or the exercise is we have to consider it from the point of view of the investor, and we have to think about who the investor likely is going to be and what the interest of that party is going to be. So, like, you mentioned private equity group. A lot of private equity groups will raise money from high net worth individuals, and they will give them some kind of forecast. Oh, sorry, it was a little hiccup.
Yeah, there's a little hiccup there.
Okay. So it's because they don't have you working at Zoom. That's the problem. So a lot of private equity groups will go raise money from high net worth individuals, and what those people are looking for is a high rate of return. But because people don't live forever, they need some kind of plan about when they get their money back. So a private equity group might raise a fund of money. A limited partnership is often how they're structured. And they'll say, we're going to raise the money for 6 months, for example, and then we're going to deploy the money. And then we're going to run businesses that we bought. And then after 5 years or something, we're going to start selling businesses with a view to having all of the money back out to people by a certain deadline, maybe in 7 years. And
Yeah.
I've never worked in that world, but as far as I understand, that's what they do. So there's some kind of investment horizon plan, right? And so for you, the question is, what is the investment horizon plan likely to be for the people that invest with you?
Yep.
So, yeah.
I think when I've been thinking this over, I'm trying to model it in my spreadsheet. The idea would be a 3-year exit, with an emphasis on bringing to the organization outreach to prior customers, outreach to current customers, increasing that cadence. Also, there's some very modern engineering practices that we can institute that will increase efficiencies of teams, and in some cases allow us to downsize teams without actually sacrificing velocity for individual features. So we can institute that. And then also with the more like long-term vision of documenting processes,
Mhm.
making sure like management is in place and up to speed on our processes so that it would be more attractive in an acquisition. And so I that was the scenario I had mapped out in my head. And so that's kind of where I was going with, I think initially, where I was thinking about some sort of like performance-based acquisition or performance-based investment terms of like, even if we didn't increase revenues at all, it's like a neutral, then we would lose like our initial investment. But if we could say 2x return or 2x revenue, we could maybe, we would collect say 35% of the exit profit. So like if it was initially acquired at say 30 million and it's at 60 million exit price, say we collect 35% of that, gained 30 million.
So, well, let's look at it within the context of this sample business that we're
Okay.
theoretically considering here, because if you doubled it from 4 million in revenue to 8 million in revenue and the costs didn't really change that much, and you still had discretionary earnings, let's say, well, in that case, they would like triple, right? They would go to almost 4 million of discretionary earnings. And so you'd be able to get a bigger multiple. So, but here's the thing. If you successfully executed all that, why would you want to sell something generating $4 million of discretionary cash flow? Right?
Yeah.
Like it's going to be hard enough for you to find and pull off this deal.
Yeah.
And so if you find it and you successfully pull it off, in my mind, what I would then want to do is I would want to take some of that money and buy back and cancel the debentures. So you're gonna pay the investors out of their positions. You're going to continue to have all these investors that own little 1% pieces of the company, but they're going to get part of the distribution every year. Like in my mind, the type of investors that you're looking for are people who might be like, their 30s or something, who are looking for something that could be very profitable, where they get their money back and generate some cash flow to them for many years.
Yeah.
And I think that you could create that kind of offer, number one, creating a security. This is what you're designing here, is you're creating a security. We're creating a type of investment people can choose to invest in. It's just like any other product. It's got features, advantages, and benefits. And if you think about the customer and you think about what that person wants, you can kind of tailor the product so that it's appealing to the customer. And then you need the right kind of attorney to do all the paperwork and stuff for you. But the second thing that you need then is the market of the people who may want to acquire that product. And given your careers and the fact that you worked with other people, gone to school with other people, that you're plugged into this network, I think that if you create this thing that will be appealing to other people like you who are doing other things in their careers, you also have the market of who is going to buy this security.
Yeah. I guess when I was pondering this like performance-based type deal, in my head, I was thinking that the eventual exit was just a consequence of us taking more, not having to front more of this money and not having to take, the personal guarantee and such, that it's just like, oh, the investor or investors would want to exit. And
well, let's consider a different scenario, because we've been talking about this scenario where the seller has a big seller note and you raise the money from other people. Another kind of scenario could be that you find a private equity group that has a lot of money, Okay.
Yep.
And they might say, okay, we will write a check for $4 million and we'll give you guys 25% of the equity and we'll keep 75%. And we have to return our money to our investors in 5 years. So you guys have to achieve all these goals so that when we sell this in 5 years, everyone gets paid out and our investors get their money and you will get, you'll get a big amount of money at the same time. So that's another kind of scenario. You would have to find, a private equity group that wants to make this kind of investment. They would have to believe in you. You would then have to find the target, and everything would have to work out. But you would basically have a boss in this scenario.
What in terms of that deal is what I'm trying to I think part of this exercise is like figuring out what is the appropriate percentage or the appropriate split to offer for that. It's like, okay, we're running the day to day, we're growing the team when it's necessary, we're keeping, uptime, we're growing revenues, hopefully meeting our 2 to 3x goal. And it's then on the negative side, we're drawing salaries, at 225K. So it's like, what is that appropriate split? Or is it a matter of, do I offer a 50-50 and then with the assumption like maybe they won't take that and then negotiate from there?
So in the like in the search funder world, there's what they call a traditional search fund, where investors put up money and a searcher goes and finds a business, and then the searcher becomes the CEO of that business. And the searcher gets I haven't studied this, but from what I understand, it's like a certain percentage of the equity, and like could be 8, 16, or 20% or something like that. And the investors get the lion's share of the equity. And, in that case, they funded the search, like they paid the person for 2 years to go and look, right?
Yeah.
So in that scenario, the investors want some kind of preferred rate of return on their money, and they want the lion's share of the equity. If you are going to get paid to do your job, the pay kind of covers your day to day. Like, this is my work week, and this is the paycheck that compensates me for my work week. So then, what is the other part of the contribution that you're going to make? It's going to be maybe finding the acquisition target and coming up with the plan of how to execute and make all that stuff work. And so it's really going to come down to negotiation. So somebody like a private equity group is going to be a very shrewd, large negotiating entity with lots of history and experience in this kind of field.
Mm.
And they're going to have all the best reasons why you deserve a smaller and smaller piece, right?
Mm-hmm.
And then they're going to remind you that without their money, that you can't pull it off,
Yeah.
right?
Yeah.
And that's just the position that you're going to be in. But you're not going to have to recruit 17 to 35 of your friends to write $100,000 check. That's the yin and yang, or the give and the take of this.
For sure. And then it's also my understanding within the context of, say, like a private equity deal, that since you now have essentially a boss, there's also like dictating of salary and such, and it's just like, do you really need that much in terms of your daily expenses and meeting your needs and such? And so,
and this stuff should all be negotiated up front, right? Like, so it's in there. But yeah, I mean, any kind of salary increase is going to be subject to their approval for sure.
yeah, for sure. Okay.
Now,
I think
you could make the seller of the private equity group. So, for example, you could, again, this is the same $4 million deal. You could approach the seller and you could say, look, here is our plan to double the size of this business, and then we're going to help you sell it when it reaches these benchmarks. You're going to have to give us, I don't know, you're going to have to give us 49% of the business, let's say. And then we will come in and do all this stuff for you, right? And so in that situation, it's the seller who basically is acting as a private equity group, but they won't have all of the experience that a PE person might have, right?
Yep.
And so you might have a little more bargaining power there. But if you can demonstrate a convincing plan to the business owner of how you can do what you claim, and they agree, I mean, that could be actually the shortest path to this.
Okay. I feel like that seems like the most promising out of all of this is like a seller based financing would have to be a pretty large percent. I think the other part of
Well,
the miss
in
or
that last scenario, there was no seller financing.
hmm,
In that last scenario, they continued to be the owner, the majority owner.
oh,
And
you're
they
right.
and they give you part of the equity in exchange for your contribution of doing these upgrades.
Got it. Got it. That make that makes sense.
Yeah.
So I think one of the other questions I would want answered, say like our hypothetical scenario of the $4 million asking price, and given those uh the revenue numbers and such, would that would have been able to a deal like that would have been able to support our three salaries as with a with our target of 2 to 3xing. I'm basically trying to come to some sort of conclusion of how do I get a rough number as to making sure that the revenue and the EBITDA or SE is going to support us well enough that we obviously can move the business into a much higher and healthier trajectory.
Well, just top level surface kind of numbers here. So in the first scenario we discussed, where you put 300,000 down and you had investor money and seller financing of 3.7 million. Let's just assume that was all at 10%
Okay.
rate of 10% interest. Okay. That would be $370,000 a year in interest payments, assuming you made no principal pay down. So this is top exposure at 10%. At 12%, it'd be a little bit more, but 370,000. The discretionary earnings that you say here are 1.4 million. So your salaries and these interest payments would be 1.1. That would leave 300,000 for taxes and any capex, which I don't know, acquisition of computers and stuff, it wouldn't add up to that much, right?
Yeah.
And so conceivably doable. I mean, I would, given what you're saying about how people renew annually, it opens up the other big can of worms in this deal about what's called deferred revenue. Because that seller was paid on, today we are in November. That seller got paid in August for someone's year-long subscription that if you bought the business today, you'd have to deliver 50% of that service, but you wouldn't be receiving the money. And so the sellers usually don't like to have this discussion because they don't want it pointed out to them that they would owe the buyer part of the revenue that they've already collected for the services the buyer has yet to render to those customers.
Oh, got it. Good point. Very good point.
Right.
Yep.
And so, yeah, there's all kinds of other stuff in this theoretical deal that would have to be looked at if it was really going to be happening.
Okay. That, yeah. Yeah. I hadn't considered that part, but for sure that definitely would have to be negotiated. So,
Yeah.
okay.
Jim, this is awesome. I rarely get to talk about this kind of stuff. So it was awesome. I know people are going to enjoy listening and watching.
I love it. In my head, I love the idea that there's many creative ways on deal structuring, and so you definitely contribute to that, and I'm constantly thinking of different ways, and so I really appreciate the feedback.
Awesome. All right. Well, happy holidays, and I hope you get to spend lots of time with family and friends.
Awesome. Thanks, David. You too.
All right. Bye-bye.